And before we go into questions, Donnie, I just have a quick question for you because I don't know this answer. Let's say I went through another lender and I locked in for a 30-day lock or a 60-day lock. You have a 105-day lock. What would, if I went through a different lender, what would a lock cost me?
So,
Like, in other words, if I couldn't close in time and I had.
Right. So typical, different banks will have different extension costs, but the general rule of thumb is every 30 days is going to cost you what's called a half a point. It's a 0.5% of your loan amount. So if you were applying for a $400,000 loan amount and you needed to extend your rate lock for 30 days, you would really have two options. Either you pay $2,000 more out of pocket, or you bring your rate up an eighth. Right. So if your rate was locked in at 3%, you could bring it to 3.125, and that will also cover a 30-day extension. So when you're shopping for a mortgage, there are a couple of things that you want to look at. It's not just looking, it's not just looking at the interest rate itself, and it's not just looking at the out-of-pocket estimate. What you want to compare is a few different things. You do always want to start at the interest rate. Hey, what are these rates side by side? But you need to know, and you need to ask, what's the cost for that rate? So if you go to any major bank's website and you look at their posted rates for the day, you have to go down to their fine print. And when you read their fine print, typically those posted rates include at least 1 point. So 1 point is a fee of 1% of your loan amount. $400,000 house. All right, that rate on their website is going to cost you $4,000 additional out of pocket to get that rate. If you don't want to pay that $4,000 out of pocket, well, then your rate's going to be 0.25% higher. Typical rule of thumb. You also want to ask what the bank origination fee is, right? So are there any points involved with the rate, and then what's the bank fee? Third question you want to ask is, what are the lock terms? How long is this rate locked in for? A 30-day lock is going to be a lower rate than a 60-day lock. Our locks, 60 to 90 days, they're the same. And then again, we have the extra 15 days of coverage just to make sure that we're covering these longer contracts for our clients. There's really not much downside to locking in a rate. I have seen competitors who maybe can't match the terms that we offer advise that they think rates are going to go down and they should put an application in with the competitor, move it forward, and they'll lock later on, and the rate should be lower. The last 9 weeks have proven that that's a very bad plan. If you follow that plan in the last 9 weeks, you could have lost over 0.5% in interest rate. And that's it's not a small amount of money out of pocket each month. If you lock in the rate and rates go up, you're protected. You have the rate that you're locked in at, all right, through the expiration date. If rates go down, this is another question that you should ask the lender that you're working with. What happens if rates move lower? Okay. With Embrace, we have a pretty aggressive float down policy. So, if we lock in, let's say we lock the rate at 3%, and we're within 30 days of closing, and that rate is now 2.75% or lower, we'll be able to renegotiate the rate for you. There's a small fee for the renegotiation, but we can bring the rate down to wherever the market is. If the market's at 2.75, we get you 2.75. If it's at 2.5, we get you 2.5. So when we lock in a rate, really the worst case scenario is, hey, we lock the rate at 3%, we get to closing and rates are at 2.875, our hands are held in that situation. But you're protected, right? If rates are at 3.625, all right, great, you're closing at the 3%. So, there's a lot of planning that goes in. It's really important to make sure that you're working with somebody who you trust. Everything that me and my team do is just, it's aimed to build that trust just because we're so thorough. We manage our clients so well. I think that, the advice that we give, I treat every loan like it was my own loan. What would I do in a situation? And ultimately, I've seen too many times these rates jump when you think they're going to go down to know it's not worth risking really floating these out for too long unless you really see something in the market that says, hey, maybe we have some room to, and even then it's, if you're happy with this, we should lock it.
Exactly.
Yeah.